In a swift and strategically calculated response, just days after the United States imposed sweeping tariffs on Canadian exports on February 1, 2025, Canada unveiled a powerful countermeasure, a massive tariff package valued at $155 billion, targeting American exports. Unlike the broad and unfocused American tariffs, Canada's approach was both precise and politically shrewd. The Canadian government implemented an immediate initial phase worth $30 billion, explicitly focusing on critical U.S. sectors known for their political sensitivity and economic influence. A subsequent phase of tariffs amounting to an additional $125 billion was scheduled shortly afterward, signaling Ottawa's determination to sustain long-term economic pressure on Washington. This carefully planned retaliation aimed to create maximum disruption in politically influential industries, including automotive, agriculture, and consumer goods sectors, areas critical to the U.S. economy and deeply interconnected with Canadian markets. By directly impacting these sectors, Canada sought not just economic parity but political leverage, aiming to turn influential American business groups and voters against their own government's aggressive trade policies. Such a targeted response demonstrated a sophisticated understanding of the American political landscape, effectively sending a message to Washington: unilateral trade measures will incur significant consequences. This strategic move by Canada marked a pivotal turning point, fundamentally altering the dynamics of the North American trade conflict and challenging the long-held assumption of unquestioned U.S. economic dominance in the region. As reported by Bloomberg, Canada's counteraction has sparked intense debate among U.S. policymakers, underscoring Ottawa's unexpected resolve and strategic depth in this escalating economic confrontation. Despite Canada's robust and targeted countermeasures against the United States' aggressive tariffs announced on February 1, 2025, the Canadian economy has not been immune to collateral damage. Official estimates indicate that these U.S.-imposed tariffs have already cost Canada's economy approximately $2.1 billion, creating significant disruptions across critical sectors highly dependent on cross-border supply chains. Among the hardest-hit sectors has been automotive manufacturing. As reported by the Wall Street Journal, Canadian automotive producers experienced severe logistical disruptions and rising operational costs as they struggled to adjust to heightened tariffs. Given the highly integrated nature of the North American automotive supply chain, spanning Ontario, Michigan, and Ohio, Canadian manufacturers have faced increased uncertainty, delays, and elevated expenses in maintaining their operations. Agriculture, another cornerstone of Canada's economy, has likewise suffered setbacks. Exports of grains, dairy, and meat products to the U.S. encountered significant tariff-induced barriers, threatening profitability and market access for Canadian farmers. Furthermore, Canada's burgeoning technology sector, heavily reliant on U.S. investments and strategic partnerships, experienced financial strain as companies navigated a suddenly uncertain economic environment, as highlighted by Reuters. While Canada's targeted response has effectively applied economic pressure on U.S. industries, this episode underscores an unavoidable reality. Trade wars produce no clear winners. Even strategic retaliation comes with substantial domestic costs. Yet Canada's measured reaction demonstrates its resolve to defend its economic sovereignty, indicating Ottawa's willingness to accept short-term economic sacrifices to secure more balanced long-term trade relations with the United States. Canada's $155 billion counter-tariff package, rolled out in two phases following the U.S. trade restrictions announced on February 1, 2025, has dealt a swift and consequential blow to American industries. Within days of implementation, sectors heavily reliant on Canadian trade began to feel the strain, demonstrating that Washington gravely underestimated the retaliatory capacity of its northern neighbor. The American manufacturing sector, particularly dependent on Canadian raw materials such as aluminum, lumber, and intermediate goods, saw rising costs and cascading production delays. Plants operating on just-in-time supply chains found themselves scrambling for alternatives, triggering temporary shutdowns and inefficiencies. According to Bloomberg, firms in the automotive and machinery segments bore the brunt of these disruptions, with executives voicing growing concern over prolonged supply instability. In agriculture, a sector politically sensitive and heavily export-oriented, the damage was immediate and quantifiable. Canadian tariffs on American beef, pork, and grains made it more difficult for U.S. farmers to access Canadian markets, resulting in a glut of unsold products. Domestic oversupply pushed prices down, cutting into farm incomes and aggravating an already volatile commodities market. The American Farm Bureau Federation warned of worsening conditions in agricultural states like Iowa and Wisconsin, where cross-border trade was foundational to local economies. Simultaneously, the U.S. automotive industry faced renewed headwinds. Tariffs on U.S. made vehicles and auto parts made these goods significantly more expensive for Canadian consumers, reducing cross-border demand and adding further strain on an industry already grappling with global supply chain fragility. In sum, Canada's retaliation wasn't just symbolic, it was surgical. By targeting sectors with strong domestic political clout and economic influence, Ottawa effectively redirected internal U.S. pressure back onto the Biden administration. The message from Canada was unambiguous. If economic aggression is the tool of choice, the consequences will be mutual, widespread, and politically disruptive. As the U.S.-Canada trade conflict escalated following the tariff impositions on February 1, 2025, the economic pain quickly extended beyond boardrooms and factory floors to American and Canadian households. The immediate consequence of this tit-for-tat trade war has been a steady and measurable increase in consumer prices, as businesses on both sides of the border began passing higher operational costs directly to the end user. In the United States, grocery store prices have surged. Canadian tariffs on U.S. agricultural exports, especially beef, pork, grains, and dairy, reduced cross-border sales, creating domestic oversupply while simultaneously making imports from Canada more expensive. This twin effect has skewed local market dynamics. The Wall Street Journal noted a 9% increase in food prices in key metropolitan areas during the first 6 weeks following the tariff escalation, particularly for meat and grain-based products. But food isn't the only area seeing inflationary pressure. Tariffs impacting consumer goods such as clothing, electronics, and household appliances have led to price hikes across U.S. retailers. Walmart, Target, and Best Buy executives warned in earnings calls of higher procurement costs due to disrupted North American supply chains, especially as materials and finished goods moved between the U.S. and Canada now carry additional duties. These increased prices have prompted some companies to scale back inventory or delay new product rollouts. Meanwhile, Canadian consumers are not exempt from the fallout. U.S. Tariffs on Canadian goods, including raw materials and intermediate products used in domestic manufacturing, have triggered similar pricing trends. Canadian importers facing higher costs from the U.S. have started to source from alternative markets, often at less favorable terms, resulting in inflationary pressure on everyday products. This inflationary spiral threatens to erode consumer spending power on both sides of the border. A study by the Brookings Institution warned that if the trade standoff continues into Q3 2025, average U.S. household costs could rise by $850 annually due to tariff-driven price increases. In essence, the trade war is proving to be regressive in nature, hurting consumers more broadly than it protects jobs or stimulates domestic production. For political leaders who hoped tariffs would bring quick leverage, the reality is setting in. Economic pain is not easily contained, and voters often feel its weight most acutely at the checkout line. In response to Washington's aggressive tariff actions on February 1, 2025, Canada's reaction transcended mere economic retaliation. Prime Minister Justin Trudeau and his administration strategically positioned Canada's $155 billion counter-tariff package not as a transactional response, but as a principled defense of national sovereignty and economic independence. This narrative shift was critical. Instead of portraying Canada as a reactive trade partner, the Trudeau government cast its actions as a stand against unilateral economic coercion from a powerful ally. In a public statement, Trudeau emphasized, Canada is willing to negotiate a resolution, but not under threats or economic blackmail. His words resonated widely among Canadians, reinforcing a sense of national unity around economic resilience rather than victimhood. This stance is significant in the context of U.S.-Canada relations, which have historically been anchored in mutual economic interdependence. By repositioning the conflict as a sovereignty issue, Canada not only strengthened its negotiating posture but also secured broad domestic support for prolonged countermeasures, even if they entail economic sacrifice. Politically, the move was astute. The targeted U.S. industries, agriculture, manufacturing, and consumer goods hold considerable lobbying power in Washington. By aiming tariffs at those sectors, Canada aimed to channel pressure back toward the U.S. administration from within its own economy. Moreover, the sovereignty narrative aligned with broader global sentiment. As noted in Reuters and Bloomberg coverage of the dispute, smaller allies are increasingly pushing back against the U.S.'s use of economic pressure as a policy tool. Canada's approach has been cited by analysts as a blueprint for how middle powers can assert agency in asymmetric trade relationships. In framing its economic retaliation as a constitutional right rather than just a policy response, Canada has recalibrated the power dynamics of the dispute. This isn't just about tariffs anymore. It's about setting limits on how far even a strategic ally like the United States can push its neighbors in the name of domestic policy. By early February 2025, the economic repercussions of Canada's $155 billion tariff response had begun to manifest across critical sectors in the United States, confirming that economic warfare is rarely one-sided. Contrary to initial assumptions in Washington, the retaliatory measures were not symbolic. They were strategically engineered to hit U.S. industries where it hurt most: supply chains and cost structures. American manufacturers, many of which rely heavily on integrated North American supply chains, were among the first to feel the disruption. Companies dependent on Canadian raw materials, particularly in automotive, metals, and industrial goods, faced soaring input costs and unexpected production delays. The just-in-time manufacturing model, common in the auto industry, proved highly vulnerable when confronted with even short-term cross-border frictions. This was particularly damaging for U.S. automakers already grappling with global supply chain challenges stemming from lingering post-pandemic effects. According to data reported by the Wall Street Journal, by mid-February, factories in Michigan and Ohio had reported parts shortages for transmissions and aluminum components sourced from Canada. The agriculture sector, long a politically sensitive area in U.S. trade negotiations, was also rattled. Canada's targeted tariffs on American beef, pork, and grains triggered surplus stockpiles in domestic markets, depressing farm gate prices. The U.S. Department of Agriculture reported that hog prices fell nearly 9% within 2 weeks due to export bottlenecks. For farmers, already squeezed by inflation and tight credit conditions, the Canadian response translated into real financial pain. This rapidly unfolding scenario exposed a critical miscalculation by U.S. trade strategists, underestimating Canada's economic interconnectivity and willingness to weaponize it effectively. While the original intent behind the U.S. tariffs may have been to create leverage, the immediate blowback illuminated how deeply intertwined the two economies are and how easily a targeted response can reverberate across borders. As Bloomberg analyst Michael McDonough noted, Canada didn't just hit back, it hit smart. The U.S. didn't anticipate this level of precision. The result? A growing realization that this trade conflict is not merely a short-term skirmish, but a strategic standoff with consequences escalating far beyond the balance sheets of exporters. The U.S. automotive industry, already grappling with rising costs and global supply chain challenges, took another hit when Canada imposed targeted tariffs on U.S.-made vehicles and auto parts in February 2025. These retaliatory duties, part of Canada's $155 billion counteroffensive, sent a shockwave through major American carmakers such as General Motors, Ford, and Stellantis, which had counted on Canada as a stable export market. The economic blow was twofold. First, tariffs made American vehicles more expensive for Canadian consumers, directly undercutting demand. According to industry sources cited by Reuters, sales of U.S. automobiles in Canada dropped by 18% within the first month of the tariff implementation. Second, auto parts manufacturers experienced a domino effect: reduced sales volumes, strained margins, and rising uncertainty in long-term contracts. This hit to cross-border trade could not have come at a worse time. Automakers were still recovering from microchip shortages and inflationary pressures on raw materials. The newly imposed Canadian tariffs further squeezed their profit margins, and factory output forecasts for Q2 2025 were revised downward across several production facilities in Michigan and Kentucky. What the U.S. perceived as a manageable dispute had quickly escalated into a crisis threatening thousands of jobs in one of the country's most politically sensitive sectors. The move also highlighted how retaliatory trade policy, if miscalculated, can deliver economic consequences in strategic sectors long thought to be insulated from disruption. The economic ripple effects of the U.S.-Canada tariff standoff are not limited to boardrooms and factory floors. Consumers on both sides of the border are now paying the price. As U.S. companies absorb higher costs for Canadian imports, many have passed these expenses down the supply chain, resulting in higher retail prices across essential goods. By mid-February 2025, American grocery stores had already begun to reflect the added costs of food imports impacted by Canadian tariffs. Meat, dairy, and grain-based products, heavily involved in bilateral trade, saw price hikes ranging from 6% to 12%, according to data released by the U.S. Bureau of Labor Statistics. The rise in household appliance and electronics prices followed close behind, a direct result of costlier aluminum, steel, and component parts formerly sourced tariff-free from Canada. Meanwhile, Canadian households also faced price increases due to U.S. tariffs on Canadian goods, particularly in construction materials, lumber, and packaged foods. The mutual inflationary pressure threatens to erode consumer confidence and could push central banks on both sides of the border into a more defensive monetary stance if inflationary spillovers accelerate. This dual-country consumer squeeze reveals how deeply integrated the North American economy truly is, and how policy missteps can directly impact millions of households. As Bloomberg economics analyst Anna Wong warned, when tariffs are wielded as weapons, it's the consumers who often become collateral damage. The stakes are no longer limited to trade policy. They now touch inflation, domestic spending, and voter sentiment ahead of election cycles in both countries. Canada's response to the February 1, 2025 tariff escalation by the United States was not just economic, it was political. Prime Minister Justin Trudeau's government framed its countermeasures as a defense of national sovereignty, pushing back against what it described as unilateral coercion from a larger trade partner. In his public address following the U.S. tariff announcement, Trudeau stated unequivocally that Canada is willing to negotiate, but not under threats or economic blackmail. This framing transformed the trade dispute from a fiscal matter into a broader national rallying point. The Canadian government strategically positioned its actions as a show of strength, not retaliation, intended to protect jobs, industries, and long-term economic stability. This posture also garnered widespread domestic support. According to a Globe and Mail public opinion poll in early February, 71% of Canadians backed the government's firm stance, even if it meant short-term economic pain. Trudeau's messaging tapped into a deeper cultural undercurrent, one that rejects economic submission to external powers, especially from the U.S., a nation many Canadians perceive as frequently overstepping its influence. The political implications for Washington are significant. Canada's positioning shifted the narrative. Rather than appearing as an aggressor, it gained international credibility as a small but resilient ally defending itself against protectionist overreach. In doing so, it complicated Washington's assumption that economic pressure would lead to quick concessions. Instead, It emboldened Ottawa's resolve and reinforced the idea that middle powers can push back when diplomatic norms are violated. By mid-February 2025, it was clear the U.S. administration had severely miscalculated the downstream effects of its tariff-heavy strategy toward Canada. Initially intended to secure trade leverage and reinforce American dominance in North American commerce, the move has instead backfired, economically, politically, and strategically. Industries that had been assumed to be insulated from foreign pressure, particularly agriculture, automotive, and consumer goods, are now reporting significant losses, supply chain disruptions, and declining exports to Canada, according to the U.S. Chamber of Commerce. American companies affected by Canadian retaliatory tariffs experienced a combined $3.4 billion in lost sales within the first 4 weeks of implementation. More critically, the political fallout in Washington is mounting. Governors from key trade-dependent states, such as Michigan, Wisconsin, and New York, are publicly pressuring the federal government to reverse or renegotiate the tariff strategy. Business lobbies representing sectors from farming to industrial manufacturing have issued joint statements condemning the tariffs as counterproductive and politically volatile. This internal backlash weakens Washington's negotiating position and highlights a broader issue, that the economic interdependence of U.S. and Canadian industries limits the effectiveness of unilateral trade pressure. As policy experts from Brookings Institution noted, in a deeply integrated trade system, economic warfare turns quickly into economic self-harm. The U.S. now finds itself in a precarious position, caught between the desire to assert control over trade flows and the growing realization that its own economic resilience may depend on restoring cooperative frameworks with key allies like Canada. In a bold and unprecedented move, the Canadian government escalated its economic retaliation by targeting one of the United States' most vulnerable sectors, tourism. Beginning in mid-February 2025, Ottawa issued a public advisory encouraging Canadians to cancel non-essential travel to the United States. This was more than symbolic. It was a calculated economic strike. Canada is the United States' largest source of foreign tourists, with nearly 21 million Canadians visiting annually. In states like Florida, New York, and California, Canadian tourists contribute billions in revenue to hotels, restaurants, resorts, and retail businesses. According to the U.S. Travel Association, even a modest 10% drop in Canadian tourism equates to approximately $2.1 billion in lost revenue, an economic shock already being felt in popular winter destinations like Las Vegas and Miami. The decision coincided with campaigns by Canadian provinces urging residents to redirect travel spending domestically. Tourism boards across Alberta, Ontario, and British Columbia began promoting national parks, cultural sites, and regional attractions as alternatives to U.S. travel. Airlines and travel agencies reported surging cancellations and redirection of bookings to Europe and the Caribbean. This strategic pressure on U.S. local economies, especially those dependent on cross-border travel, has sparked concern at both state and federal levels. Governors in Florida and Nevada have urged the White House to de-escalate tensions, citing severe risks to seasonal employment and tourism tax revenue. Canada's move illustrates the effectiveness of soft power economics. By leveraging the free choices of millions of consumers, Ottawa has amplified the pressure on Washington without triggering direct confrontation, the U.S. which had expected a passive Canadian response, now finds itself scrambling to address not just industrial fallout, but also a sudden, consumer-led backlash. As the U.S.-Canada trade war intensified, Canadian provincial governments stepped up their own economic resistance. Provinces like Ontario and British Columbia began enacting targeted procurement policies aimed at reducing reliance on American imports, another layer in Canada's multi-front economic pushback. A key example emerged when the Ontario Liquor Control Board announced its plan to remove U.S.-made alcoholic beverages from its retail shelves, redirecting purchases toward Canadian and European alternatives. While this might seem like a niche policy, it signals a broader shift in consumer procurement strategy, one designed to diminish U.S. economic influence in everyday markets. British Columbia followed suit by launching initiatives that prioritized local manufacturers for public contracts in construction, transport, and healthcare. The move is being framed domestically as both economic patriotism and strategic resilience. Canadian officials argue that overdependence on U.S. suppliers is a structural vulnerability that the country must now correct. The implications for American businesses are significant. U.S. exporters, especially in food and beverage, apparel, and building materials, now face reduced demand and tighter access to one of their most dependable markets. According to Export Development Canada, preliminary estimates suggest these import substitutions could affect over $4.5 billion in annual U.S. exports. This strategic decoupling isn't just a short-term response. It signals a long-term recalibration of Canada's trade posture. By deepening ties with the European Union and reviving stalled trade talks with ASEAN nations, Canada is actively diversifying its partnerships. For Washington, this development raises a critical concern that an overuse of tariffs as a geopolitical weapon may drive even close allies to seek alternatives and accelerate the erosion of U.S. trade dominance in North America as the U.S.-Canada trade conflict escalates. American agriculture, long a politically sensitive sector, is emerging as one of the hardest-hit victims. Canada's retaliatory tariffs on American agricultural exports, including beef, pork, grains, and dairy, are already reshaping the dynamics of U.S. farming. These tariffs have significantly weakened U.S. competitiveness in the Canadian market, which has traditionally been a top 3 destination for American farm goods. In states like Iowa, Wisconsin, and North Dakota, where agricultural exports to Canada form a vital part of the local economy, farmers are now facing a critical crisis. Without access to their northern neighbor, many producers are dealing with a mounting surplus of unsold goods. That surplus has had a deflationary effect on domestic prices. With an oversupply of pork, beef, and grains flooding U.S. markets, prices have dropped below break-even levels for many producers. According to the USDA, average corn prices fell 11% year-over-year by March 2025, while wholesale pork saw a 9% decline. This financial strain is particularly severe for small and medium-sized farms that lack the capital flexibility to absorb short-term revenue losses. Several farm cooperatives in the Midwest have reported delayed equipment purchases, reduced seed orders, and postponed hiring, all indicative of a sector tightening its belt. Beyond immediate losses, the reputational damage to U.S. agriculture could have lingering effects. Canadian importers are now actively seeking alternate suppliers from Europe and Latin America, raising the risk that U.S. market share could permanently decline even if tariffs are lifted. In sum, what began as a trade strategy is fast becoming a structural challenge for America's farming future. The ripple effects of Canada's retaliatory measures have moved beyond the farm and into the factory. U.S. manufacturing sectors that depend heavily on Canadian raw materials, especially aluminum, steel, and auto parts, are now struggling to contain rising costs and maintain production continuity. These disruptions are most visible in the industrial heartlands of Michigan, Ohio, and Illinois, where factories rely on Canadian inputs under just-in-time logistics models. With Canada's counter-tariffs and import restrictions taking hold, production lines are facing supply delays and price surges. According to data from the National Association of Manufacturers, average material input costs rose by 6.7% in Q1 2025, compared to just 1.9% in the previous quarter. For example, automakers such as General Motors and Ford are now paying significantly more for Canadian steel and specialized components. These rising costs are either absorbed, hurting profit margins, or passed on to consumers in the form of higher vehicle prices. This creates a secondary effect, reduced consumer demand, which then feeds back into lower production volumes and, in many cases, workforce reductions. The impact is not merely financial, it's also political. Worker layoffs and plant slowdowns have begun drawing attention from state legislators and union leaders. The United Auto Workers Union issued a statement in late March 2025, warning that continued tariff conflict risks turning temporary strain into long-term contraction. From electronics to construction materials, the message is clear. The deeply integrated supply chain between the U.S. and Canada cannot be disrupted without significant domestic repercussions. The more prolonged this trade war becomes, the more vulnerable the U.S. industrial base grows, not just economically, but competitively on the global stage.